Today we're diving into the most profitable fund of 2023. And no, it's not stocks or crypto. It's something called Catastrophe Bonds, or CAT bonds for short. You heard that right. Talking about bonds tied to natural disasters. Intrigued? You should be. In 2023, CAT bonds delivered an astonishing 20% return, all while remaining remarkably stable. To put that in perspective, US government bonds barely manage single digits, and Bitcoin, it can swing 20% in a single day. But here's the punchline. CAT bonds aren't about chasing yields alone. They're about managing risk. So how can something so risky produce steady double-digit returns? Stick around because we're about to unpack how CAT bonds work, who issues them, why hedge funds obsess over weather models, and what happened in 2022-2023 to create this perfect storm of profits. Let's start with the basics. A catastrophe bond is like any other bond. You invest capital, you receive regular coupon payments, and you get your principal back at maturity unless a predefined disaster occurs. Hurricanes, wildfires, earthquakes. If those events breach specific thresholds, investors can lose part or all of their principal. Think of it as betting against Mother Nature. Imagine a 5-year bond tied to Florida hurricanes. Every year you earn your usual risk-free interest plus an extra 10% risk premium. But if a Category 4 storm makes landfall in Florida with wind speeds over 130 mph, you could lose your entire investment. It's like getting 10% more return each year unless Florida gets hammered. That's the trade-off. Why is Florida such a hotspot? After the pandemic, remote work sent people fleeing crowded metros for sunny shores. Home prices in Florida surged, insurance demand spiked, and with that, insurers sought new ways to hedge against catastrophic losses. Enter Florida hurricane bonds. But CAT bonds aren't limited to Florida. There are California fire bonds, Japanese earthquake bonds, even flood bonds for New York City. And get this, in November last year, the market launched a cyber catastrophe bond. If a major hack triggers defined losses at a corporation, investors will lose principal. The financial engineers really got creative. So why buy these? Simple. High yields with low probability of loss. Typical risk premiums range from 3% to 15%, averaging above 8% in recent years. Annual disaster probability, only 0.5% to 2%. That means you're trading a tiny chance of wiping out your principal for 8 to 10% excess yield. Tempting, right? But this space isn't for ordinary retail investors. It's dominated by specialized hedge funds. These funds don't rely on typical quant models alone. They hire meteorologists, seismologists, climatologists, and they buy tons of NVIDIA GPUs to run complex simulations of hurricanes, wildfires, and earthquakes in real time. Their edge, accurately predicting disaster probabilities and trading on real-time price movements when storms brew offshore or fires ignite. Picture this, a hurricane forms in the Atlantic, churning toward Florida. As the forecast models shift, the market's perceived chance of landfall might spike from 40% to 60%. CAT bond prices plummet. If you're a sophisticated hedge fund and you foresee the storm veering away, you buy the dip, then profit handsomely when it bypasses land. Conversely, if you hold bonds during an escalating threat, you might sell ahead of the crash to avoid losses. It's active, weather-driven trading, far removed from buy and hold strategies. Let's zoom in on the stunning event that set the stage. Hurricane Ian in September 2022. Ian became Florida's costliest storm ever, over $100 billion in losses. Multiple CAT bonds triggered, scaring off investors. As global warming fears mounted, buyers fled, driving prices and yields into the stratosphere. The catastrophe bond market posted negative returns in 2022. Fast forward to 2023, no major triggers. Investors collected generous coupons, prices rebounded, and that fear-driven sell-off reversed. The result? A 20% total return for the year, the highest in CAT bond history, but historical averages are closer to sub 10%. So this was truly a once-in-a-decade scenario. Who needs this strange financial instrument? primarily insurance companies and governments. Insurers face systemic risk when thousands of homeowners file claims after a storm, risk that can't be diversified away. By issuing cat bonds, insurers transfer part of that liability to the capital markets. Governments of hurricane or earthquake-prone regions, think Florida, California, Japan, also issue cat bonds. Developing nations such as Mexico, Chile, and Jamaica often partner with the World Bank to access global capital for disaster risk financing. From an investor's perspective, cat bonds offer two key benefits: high yields and low correlation with traditional assets. A portfolio of stocks, bonds, and cat bonds can see reduced overall volatility because natural disaster risks are independent of equity or credit markets. By allocating even a small percentage to cat bonds, you strengthen diversification, much like adding gold or volatility strategies, but with a unique payoff profile tied to weather and geological events. Let's simplify the chain. Consumers buy home and flood insurance. Insurers pool premiums but face enormous systemic risk. Insurers, governments issue cat bonds to offload that risk. Investors buy cat bonds for yield and diversification. Everyone's risk is transferred and shared without having to bulk reserve massive capital for unlikely but devastating events. Notice that investors are not in it for altruism. They chase pure profit, yet their capital plays a vital social role. They provide the capacity that backs insurance claims when hurricanes strike or earthquakes rock a nation. Cat bonds emerged in the early 2000s, pioneered by Goldman Sachs. They represent the magic of finance, using securitization to allocate risk and return efficiently across markets. A well-structured cat bond contract sets clear triggers and attachment points, turning complex natural hazards into tradable securities. As climate change intensifies, we'll likely see more inventive structures, parametric triggers based on satellite data, hybrid bonds covering pandemics, cyber risks, and beyond. The cat bond market could be the next frontier for risk transfer. To wrap up, catastrophe bonds turn nature's fury into investable streams, rewarding those willing to shoulder tiny odds of ruin for outsized, uncorrelated gains. They showcase how finance can distribute and manage systemic risks that no single insurer or government could bear alone. What do you think? Would you consider allocating a slice of your portfolio to cat bonds? Let us know in the comments. And if you enjoyed this deep dive, give us a thumbs up, subscribe, and hit that bell icon. We've got plenty more content on alternative assets, hedge fund strategies, and the evolving world of finance. Thanks for watching, and until next time, stay informed and stay diversified.